update webinar. So it's good to have everybody here today, and we appreciate your time here on this Friday afternoon. As always, Matt, Bill, and Beth are joining me from their respective locations. And so let's jump right into it. You know, this week has been a little interesting. Market's been up a little bit, markets have been down, and so we're going to address it. So let's talk about what our key points are for today. Before I do that, I want to remind you that you can submit questions. There's a question box. If you want to submit a question, that would be great. We'll see if we can get to it during our time. We'll be glad to answer those questions. And so our topics today are price earnings ratio. We want to dive into that a little bit and really what does it mean, kind of give you a high level, our view and the view of what that does mean and what it means to the market. We're going to talk about we're on pause. We're on hold, or we're pausing right now, we believe, in kind of the market and the economy. We're going to talk a bit about that. And then if you're following the news, you know that there's been some discussion around negative rates and what do they mean. And so we want to address that as well. At the end, we're going to talk about a couple things that are coming up. We made an announcement last week, and many of you have already participated in our matching program for the benefit of some charities. So that's great. And we got a couple other announcements. So hang in there till the end. So the first topic, price earnings ratio. So Bill, I think you were going to take this topic and start us off.
Yeah, thanks, Eric. I think we have a graphic of the Cape-Shiller. I think I just wanted to clarify why we're not recommending any more overweighting in equities at this point in time, and partly it has to do with this graphic that you see on the screen. It's commonly referred to as the Cape-Shiller. It was established back in the 1800s, and it really gives us the opportunity to see what kinds of multiples companies are trading at. And so you'll see that we had a spike in December of 2019 that was at 44, and today we're actually at 2668 as of this very moment, even up from the 25.9 as the date as May 1. And so so we're the 10-year the average all the way back to the beginning of this Cape-Shiller is around 16.7. And, that spike in 1999 was what was referred to as the tech bubble. And we're not expecting anything like that. The problem that we see right now is that without forward guidance from companies, it's very difficult to look at future projected price to earnings ratios. So that's why both Matt and I have stated, and I think Beth as well, that we think that the market got a little bit ahead of itself in where it's at now, because calculating what an actual stock price should be or what the company's valuation is becomes very difficult, because this quarter on the quarterly earnings calls, most of the corporations are not giving what's called forward guidance. And that means what their profit projections are going forward for the next 3, 6, or 12 months. And so how can you calculate forward PEs if you have no kind of guidance and no kind of handle on this pandemic that tells us that companies are going to actually be able to calculate what their profits are going to be? So that's why we wanted to show this graphic, just to get grounded in the fact that the market, we think, is still ahead of itself. We had a record retail decline month over month, and the market's up today. So it continues to act a little schizophrenic.
Yeah, and I think that on the retail side, you mentioned that, Bill, briefly, but they're saying that many of these stores will open just to file bankruptcy. So they'll kind of reopen, reestablish themselves, and then go through the bankruptcy process. So would you say, and this is open up to anyone that wants to bring it up, but if you look at this back in 2008, 2009, at least, it dropped way down. You can see that, you know, we were, and some say the multiple was actually a little bit over, the ratio was a little bit high. And you can see why it fell out of that kind of that median, right?
Well, you see the beginning of the greatest bull run in the history of the stock market is right at 2010.
Yeah.
And so from there on up, you know, that's the greatest bull market in the history of the stock market.
Yeah. 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 So thanks, Bill. Any other comments on PE and as we think about it, I think the you know, the company's not you know, talking about projections, you know, certainly reduces the amount the analysts can actually look at. You know, there's certainly the data, but they just don't get a sense of where they're going to land.
I think it's a good point. I do think that, you know, the complexity of looking at prior data obviously doesn't have stimulus involved, right? So we've seen a lot of stimulus or relief involved in this. I think the other thing that comes into play is, you know, growth stocks or technology stocks traditionally trade at a much higher PE than a Walmart or a Procter & Gamble. And so you definitely have the shift of PE ratios moving up historically, right? So even this is showing you back to 1950, but to Bill's point, you go back even further, the averages are around 16. This is, you know, starting to creep up to 20. So all things considering, I think that, you know, the recovery is probably that we've seen is relatively justifiable, but forward earnings is what's in question at this point. And you're at a month and a half now, or 8 weeks, 6 weeks, whatever, longer than what we've already experienced in the first quarter with poor earnings. So I do think that we'll get a little sense of reality of some pullback. So not that we're saying get out of equities. I think they're definitely you need to be there because there's still a lot of strong companies in there, right? The NASDAQ's positive year to date. And that's primarily due to the fact that those technology companies are still churning profits. Your Microsofts and your Netflix, Cisco's, right? Because they have stay-at-home protection moats around their business models. But that doesn't necessarily mean everybody in the S&P is positive. So, you know, again, there's still a lot of really good stocks out there. So it's not that we don't want to own stocks. We're just saying now is probably not the time to go make a bunch of purchases in individual stocks unless you're buying specific names.
Yeah. Yeah. Yeah, it's a good point. And yeah, when you do look at that, the way the technologies, the big ones are driving it, you know, and we've been talking a lot about you know, you know, we've talked on this webinar over the last many weeks, you know, the Main Street and Wall Street they're not working together, you know, it's not, and they're not tied together, and it just is a continuing head scratch, right? We had some down days this week, and then unemployment comes out, the unemployment number, and the markets go up. So just it's just been a kind of a mystery there. Any other comments on the PE side? So one of the things we wanted to talk about was, you know, we're in a bit of a pause. We're in a bit of a just kind of you know, just not a lot of growth lately. Of course, we had a great April. Not a lot of downside really. So what do we mean by that, Beth?
Turning my mic on would be good. I was on pause. You know, we had a whole lot of activity at the beginning of this, whether it was the stimulus packages or you know, as things shut down so quickly, and getting a sense for, you know, with the virus, where was it peaking, when was it peaking. There's a lot of activity going on, and over the past couple of weeks, it's been a little quiet. There hasn't been a whole lot of new news coming out of Washington. We do feel like we're on pause. I mean, there is discussion in Washington about the next phase of the stimulus package, going to a vote today, probably going to be declined. We've got the two parties going back and forth, maybe a little bit more politics involved now than a month ago, when there was urgency as far as getting something to help people out. The Fed had its big influx of dollars, a few weeks ago. There's talk at this point in time. The Fed is buying into corporate and muni ETFs this week to help stimulate that a little bit. So yeah, it's we're not coming to you on these webcasts over the past couple of weeks going, did you see this? Did you know about that? Everything just kind of seems to be on hold and waiting to see what will happen as all of the states start opening up and dialing up that activity again. How many jobs will we see people coming off of furlough and going back to work? What are the extent of maybe longer term layoffs? And to the point we made earlier, what businesses may open up to simply move into bankruptcy. So just kind of on pause and waiting for the wheels to crank underneath it all and see what the eventual impact of that's going to be.
Yeah, we were talking about, as a team, certainly we've kept it on the financial side, and that's where, what we do every day. But, Bill, we were talking about still those unknowns out there. If they come up with something from a medical standpoint, sooner, that could be great. If they don't, or it kind of comes back. Right, states are starting to open up and things go the other way. Markets are going to react negatively.
Well, yeah, I mean, I picked up on that there's 29 different companies currently that are working on different aspects. I think we put together a graphic, and so it's a race to the finish line. And so whether it's going to be a vaccine, whether it's testing, for biomarkers and other areas that, and I think that President was just announced not too long ago that they're going to pump money into these companies that think have the best chance to develop a vaccine more rapidly. So that'll be a first. Now we'll stimulate biotech companies to try to increase their R&D and the people that are working on these vaccines, because it seems to be a pretty broad-based thought that people aren't going to go out to back to retail, back to restaurants, back to travel without a vaccine. And I still think we're probably 12 to 18 months away from that.
Yeah, and Beth, you in our discussions, I thought it was a really good point. I think it's a positive point, and I've said this for many, many weeks to many folks, many clients, and so forth. That you think about, we have very positive, the smartest scientists, researchers, and doctors working on this. And your point was, and they're all focused on one goal.
Yeah, there's one goal, and this is worldwide. It's not just here in the States. It's worldwide that these, universities, hospital groups, pharmaceutical companies, all focusing on one goal. I heard the analogy this week, it's one goal. And, being here in Detroit, where, we live in hockey town, it's like we've got all of these companies taking a shot on goal. And so we've got so many different shots on goal. The more shots you get, the more goals you're likely to have. And I think that, in my opinion, 12 months, 18 months from now, we're not going to have just one vaccine. We're going to have multiple different means of delivering that vaccine, whether it's a vaccine, if it is treatments, therapeutics, whatever the case may be. All of these companies and all of these incredible, medical personnel and scientists are going to come up with, I think, a variety of different answers for us. It's just going to take some time. We're looking at this list of companies. I was reading through them earlier today and what they're doing. And, it's companies working together as well. Some of these startup biotech firms with some of the larger established ones like GlaxoSmithKline and Gilead Sciences and so forth. And many of them are into human trials. already, and those take time. But they're kind of into the next phase of seeing if these things really work. I don't know if people have heard there's a at Oxford University in England, they feel like they're as close as anybody else to getting this, and they've had the vaccine work in a series of macaque monkeys, I think, and they're moving on. They've already started with human trials with those as well. So lots of shots on goal. Somebody's going to get it through, and we'll get some answers here in the near future.
Yeah, thanks. We'll post for everyone on the webinar. We'll post that article in the Market Resource Center on our website, and it's very interesting, as Beth was saying, as to getting into the details of it. So it really lays it out. So we have a question, Matt, on the impact of the Chinese tariffs on the economy. What happens as they continue, and what will happen when they end? And are they slowing global growth even more on top of the pandemic? So what do we think?
Week to week. Sir, you're giving good questions. I like these questions. I think the goal of the tariff at this point is really to try to help drive the U.S. economy, and so if you can increase the cost of goods on Chinese tariffs, but force companies to try to push production here from the U.S., I think the ultimate goal there would be you're putting U.S. citizens back to work and making companies in the U.S. profitable. That's really the ultimate goal, I think, of these tariffs. The complexity is, everybody wants that, but nobody wants to pay the price for the end product. So how do you have both of those, I think, is really what that comes down to. So you're going to find this fine line in between where some people will still go overseas for product and some people won't. We'll probably see more incentives for companies to bring production back here, or obviously that's just what a tax would be, a tariff tax would be. So do I think that there would be some global slowdown because of that? That's hard to say right now, primarily because I think the supply chain is so disrupted that it would be really difficult to just huddle up and only use U.S. product at this point.
Well, I've heard there's quite a pent-up demand for U.S. Agricultural products that, hey, we might as well collect some tariff money off those guys if we're going to be shipping to them.
Right. And so I think they're trying to find this weird balance. Do I think that long-term that the global slowdown would come from that? There's only so much that you can do in the U.S. So if they don't go to China, they're going to have to go somewhere else. So I don't think so. I think long-term, a lot of this stuff reverts to the mean. And so you might have some years where you're going to see trade deficits, positive or negative, but I think it would be really difficult long-term to eliminate somebody like the use of China, because again, for companies to stay competitive, they can't just be U.S. based. So there might be a little bit of a slowdown in the short term, but again, to Bill's point, I think the supply chain, people needing our product, it's going to be a give and take. So I'm not terribly concerned with it. I think it's just looking for solutions and scratching.
Yeah. Thanks. Thanks for the question, and thanks, Matt. So let's look at some other bullet points that we have. So equities are a little pricey.
I'd say be patient. Be patient. We saw a little pullback this week, and now we're rebounding a little bit. There's going to be some bad news, and the bad news is going to cause people to pull the trigger and reduce their equity exposure. So opportunities will come. I think they'll come in healthcare. I think they'll come in technology, and probably cloud-based technology, 5G, looking at that as an opportunity. And right now is an opportunity in small caps.
Yeah, I jumped a little bit ahead, but that's okay. We're just kind of jumping around, but we didn't, I think it'd be helpful to just address the negative interest rate thing, because I think that was, certainly in the press this week, probably from a market perspective in the forefront. So let's talk about that. Do we think negative interest rates is going to happen? And what are the effects if they do?
Yeah, so negative interest rates, that was something that was in the news, and I think we saw it reflected in yesterday's the discussion of it in yesterday's market and the rebound that happened late in the day yesterday. So, negative interest rates it's a policy set by the central bank, and negative interest rates first and foremost start with the central bank saying that they're going to pay larger banks to park money with them. So if banks are not lending out money, if people are storing and not spending money, the central bank, in our case, the Federal Reserve, could say, well, we're going to charge you a fee to have your money just stored here for a while. And really what it is, it's an incentive for banks to lend, try to stimulate the economy by pushing more money out with favorable loan terms. It doesn't mean that somebody's going to pay you to take out a mortgage. But we're seeing lower interest rates that are the result of it. So Jerome Powell had a meeting this week. He stood up and he said, yep, there's some dialogue about we should go to negative interest rates the way Japan did. In 2016, there were different countries in the Eurozone, Sweden in particular, that went to negative interest rates, and not too much has happened of that. If people are leery of the economy and leery of the markets, and I think we saw a little of this over 2011, 10, 11, 12 too. Interest rates are really low, but there wasn't a whole lot of lending going on, or people borrowing money at that point in time. So negative interest rates can be an incentive to make loans, to spend money. But if people aren't feeling confident to do that, to take out a long-term loan, companies and manufacturing places, if they don't know where their profits are going to come from, if they're going to have enough earnings or profits, they're going to be a little nervous about taking out a long-term loan. So negative interest rates, can incentivize growth, but if you're not feeling good about spending money or committing to a long-term loan, you're not going to spend that money anyway, and so it could just leave the economy flat, like we've seen, always as Japan as the example of that. So that's my take on negative interest rates, and Powell said it's not going to happen, that the Federal Reserve is not going to go there. So wait and see, I guess. Maybe that's something else that's on pause.
Yeah, I think the investment community certainly doesn't seem to be behind that notion of this negative interest rate side. So, Bill,
well, think about it. Yeah, think about a bank charging you for having money in savings, passing along to you the fees that they're paying the Federal Reserve for being overweighted in cash. Yeah. And bad enough that a bank sends you a $5 bill for printing a statement. They could easily pass on, a charge to you for having money in their savings account.
Sure. I mean, a worst case scenario of that is you say, well, I don't want to spend my money. I'm taking that money out and it's going in the mattress, right? And then do you run a risk of running on banks and all of those sorts of things? So it can be a negative returns, negative effect as well.
Yeah. So we're back on this a little pricey. So thanks for the comments, Bill. And you talked about being patient. So other comments on those two topics? Hey, covered it all. So we do think though that just because someone didn't get in today or next week, it's not that they're going to miss it. And like we said, there's going to be still some volatility ahead. What are some things that,
Erik, if I could, I just like, we can be a little bit late following the trend. We don't have to be the cutting edge and start the trend. We can wait to see if the trends are going to develop and hang on, and be consistent before moving back in. So that's how I think about being patient.
Yeah, it's good. So other things that we can do to take advantage of during this time from a financial perspective. Low interest rates. I know we've had some clients that have purchased, a home refinanced a home. So what are some other things that folks can think about?
Yeah, I had a client this week that got an interest rate for a 15-year loan down in North Carolina for 2.59 for their, second home where their only son is located and their grandchildren. And it just made some sense. I mean, we're never going to have money cheaper than that.
Yeah.
that we can borrow. So there's one example, is either refinancing, purchasing that condo that you're looking at in the vacation, the vacation property, the lake home. Beth, I think that you should get yourself a lake home.
I think I should have a lake home as well, Bill. I think that's a really great idea. And I'm laughing because, again, 10 years ago, we said that interest rates will never be lower than this, right?
Right.
And we were wrong.
Yeah, it's absolutely been amazing. Other things to keep in mind that we've been talking with folks about is Roth conversions. I mean, we are in the lowest tax rates historically. And, because of all the stimulus money and, we're obviously not done, it's going to add up to the multiple trillions of dollars. And that's what they're there. I mean, they're there to help us through this they can come up with the money, but when we get through this, then they also have the right to ask for a way to pay it back. And so Roth IRA conversions is another thing. And we were talking about recently on one of our meetings, Matt, right? Car loans. Would you say?
Car loans.
84-month car loans.
Right. Even if you got one where you're thinking, well, I got another X number of, 18 months left on this car before I really want to get another loan, or, it's on my last leg, but I'm trying to ride it out. It might be time to just take a look at that, see what the math works out to be. 0% for, or incentives. There's a lot out there. Bill, you were talking earlier today about, appliances. I got a feeling Memorial Day appliance sales are going to be pretty impressive this year. So those purchases where you're saying, hey, should I just wait 6 months and ride this out? Or, I would begin to look at those opportunities to say, where can I save a buck?
Yeah, if you have something you have to replace, I don't think the financing options will be any better. Whether you're doing it on zero interest for a year or whatever, I think the opportunity there's going to be a lot of commodities out there that I think are going to be on sale. And in my case, I hope it's appliances.
Yeah, absolutely. So, thinking about if you're in that as an opportunity, we talked about making sure that, you have enough in cash. So many of you are retired and taking money. We want to make sure we've got enough, in cash or somewhere where you're going to get it that's not market susceptible. So that's another piece of it as well. So several things that you can look at to kind of take advantage now. And the refinancing part, it really just depends. Oftentimes we get asked, I know, should I refinance? It depends how long you're going to stay in the home. It depends on your current interest rate, the cost of closing, and things of that nature. So, but to Bill's point, even on the second home, Bill, right, just under 2.5%, pretty amazing. So,
yeah, I think the other thing to pay attention to is, home equity lines of credit. Banks not financing those. Some banks are slowing down on opening those. Because they are hoarding cash. They want to make sure people can make payments, those types of things. That bleeds back into the negative interest rate environment and trying to stop people from hoarding cash. But I do think that, if you're looking at that home project next year, again, you might want to, or in the next 6 months, just pay attention to those types of things to make sure financing is going to be available for you. I would start the process earlier than you'd want to normally start the process, just to make sure it's there.
Yep. Well, good. Well, a couple of announcements that we have just to make you aware. These weekly webinars, we're going to move those to a bi-weekly webinar for now. And so the next one will be on the 29th, Friday the 29th, which is hard to believe. It'll be almost the end of May. If we need to, you know, if there's breaking news or things that we really want to deliver a message to you, we certainly will do a webinar and we'll pull one together quick to kind of educate you. But we're going to take it in every other week right now. And as we talked about, we feel like we're a little bit on pause. That doesn't mean there's not going to be volatility, but that's the first announcement. Secondly is we've had already a very good response to our Together We Can Make an Impact campaign. So thank you for that. And so you can go to our website and help us out. But we want to help the communities. We want our clients to help the community take advantage of a tax deduction. And so we've got this matching program that's going on. And so if you have questions, you can certainly talk to your advisor, or you can talk to Denise Dirks in the firm. She's handling that. So thank you for that. And we want to continue to push to help everyone that's affected by the global pandemic. And then the number 3 topic is we are going to have a workshop that is, we're having a special guest. So his name's Robert Siciliano. We've had Robert on the Your Wealth Health show, and we've been engaged with him in utilizing his knowledge. He is one of the premier leading experts in cyber crime and identity theft. He's been on more than 500 TV shows, including the Today Show, Fox News, CNN, pretty much you name it, he's done it. He's worked with companies like UPS and Caterpillar, and so he there's also a best-selling book. And so we're going to have a workshop on the 28th of May at 6 o'clock. So look for an email for that. In fact, what you can do is you can go to our website. So we'll show you the website here. We get the technology going. I guess we can, but you can go to the website and you can put it under the under upcoming events and sign up for that. And we'll have him live. And I think it'll be a great event. So everybody here should rush and sign up for that, because this is just fully increased as it relates to cybercrime. You know, he'll be taking questions as well. And he's got a lot of knowledge, so we're very happy to have him. With that, I'm going to say thank you from Bill, Matt, and Beth, as always, for joining today. And we want to thank each of you for joining us today. And hope you have a great weekend. And if we don't talk to you, have a great holiday weekend. And we will see you on the webinar on the 29th. Actually, the 28th. We'll see you with Robert on the 28th, and we'll see you the next day on the 29th. Thanks, and goodbye.